Bitcoin mining is the backbone of the Bitcoin network. It is a process where powerful computers solve complex mathematical problems. This process verifies and adds transactions to the Bitcoin blockchain. Miners compete to solve these problems, and the first to find the solution gets rewarded with newly minted Bitcoins. This process is crucial for the security and integrity of the Bitcoin network. It ensures that transactions are valid and prevents double spending. Without miners, the Bitcoin network would be vulnerable to attacks and could potentially collapse. The mining process also controls the rate at which new Bitcoins are created. Currently, miners receive a block reward for each block they add to the blockchain. This reward, along with transaction fees, incentivizes miners to participate in the network. One of the fundamental principles of Bitcoin is its limited supply. Unlike traditional currencies, which can be printed infinitely by governments, only 21 million Bitcoins will ever exist. This hard cap is written into the Bitcoin code and cannot be changed. This scarcity is one of the key factors driving Bitcoin's value proposition. It mimics the scarcity of precious metals like gold, which has historically been a reliable store of value. As demand for Bitcoin increases and supply remains limited, its value is expected to rise. This limited supply also has significant implications for the future of Bitcoin mining. As we approach the 21 million limit, the block rewards for miners will decrease. This raises questions about the long-term sustainability of Bitcoin mining and the security of the network. The last Bitcoin is predicted to be mined sometime around the year 2140. When this happens, it will mark a significant milestone in the history of Bitcoin. It will be the first time a digital currency has achieved its predetermined supply limit. This event will also usher in a new era for Bitcoin mining. With no more block rewards to incentivize miners, the network will need to rely solely on transaction fees. This raises questions about whether transaction fees will be sufficient to maintain the security and stability of the network. The mining landscape will likely change significantly. Smaller miners might find it unprofitable to continue operating. Larger mining pools could become even more dominant. Transaction fees are small amounts of Bitcoin that users pay to have their transactions processed and added to the blockchain. They act as an incentive for miners to prioritize and include transactions in the blocks they mine. Currently, transaction fees make up a relatively small portion of miner revenue compared to block rewards. However, as block rewards decrease and eventually disappear, transaction fees will become the primary source of income for miners. Whether transaction fees will be sufficient to sustain the network is a topic of much debate. Some argue that as Bitcoin adoption grows, transaction volume and fees will increase proportionally, keeping the network secure. Others are concerned that high transaction fees could make Bitcoin impractical for everyday use, hindering its adoption. Section 5. Store of Value Digital Gold. As Bitcoin matures and its supply approaches its limit, it is increasingly being viewed as a store of value rather than just a transactional currency. This shift is driven by its scarcity, its decentralized nature, and its potential as a hedge against inflation. Bitcoin shares many characteristics with gold, which has been a trusted store of value for centuries. Like gold, Bitcoin is scarce, durable, divisible, and easily transferable. These properties make it an attractive option for investors looking to preserve their wealth over the long term. This shift towards a store of value could have significant implications for the price of Bitcoin. As more investors view Bitcoin as a safe haven asset, demand could increase significantly, pushing its price higher. Section 6. Economic Impact, a Paradigm Shift. The rise of Bitcoin and its potential as a global currency could have a profound impact on the global economy. Its decentralized nature challenges the traditional financial system and offers an alternative to government-controlled currencies. For individuals, Bitcoin offers a way to escape inflationary pressures and participate in a global financial system without relying on banks. It also facilitates cross-border transactions with lower fees and faster settlement times. For institutions, Bitcoin presents both opportunities and challenges. While some institutions are embracing Bitcoin and offering Bitcoin-related services, others are wary of its disruptive potential and the regulatory uncertainties surrounding it. Section 7. Network Security: A Decentralized Future. One of the key concerns about Bitcoin's future is the security of the network after the last Bitcoin is mined. With miners relying solely on transaction fees, there are concerns about whether the incentive will be strong enough to maintain a high level of security. However, Bitcoin's security model is designed to be robust and adaptable. As block rewards decrease, the network's security will increasingly rely on the combined power of countless individual miners around the world, making it extremely difficult for any single entity to gain control. Furthermore, the Bitcoin community is constantly exploring new technologies and solutions to enhance network security and efficiency. These innovations, along with the growing hash rate of the network, provide confidence in the long-term security of Bitcoin. Section 8. Governance and Consensus: The Path Forward. As a decentralized system, Bitcoin faces unique governance challenges. Decision-making processes are distributed, and there is no central authority to dictate changes or resolve disputes. This raises questions about how the Bitcoin network will adapt to future challenges and evolve over time. Currently, Bitcoin's governance relies on a combination of factors, including the consensus of its users, the development community, miners and businesses operating within the Bitcoin ecosystem. This distributed governance model has been remarkably resilient, but it also presents challenges in terms of reaching consensus and implementing upgrades. As Bitcoin continues to mature, it's likely that its governance mechanisms will need to evolve to better address emerging challenges and ensure the long-term sustainability of the network. Section 9. The Future of Bitcoin: A Decentralized World. Despite the uncertainties surrounding the last Bitcoin being mined, one thing is clear: Bitcoin has ignited a revolution in finance and technology. Its impact extends far beyond its price fluctuations and has the potential to reshape the way we think about money, value, and trust. Whether Bitcoin becomes a dominant global currency or primarily serves as a store of value, its underlying technology, the blockchain, is already transforming various industries. From supply chain management to digital identity, the applications of blockchain technology are vast and still being explored. The future of Bitcoin is ultimately tied to the continued growth and evolution of its community, its technology, and its adoption by individuals and institutions worldwide. While challenges remain, the potential of Bitcoin to create a more open, transparent, and equitable financial system is undeniable. Section 10. Conclusion: Embracing the Change. The mining of the last Bitcoin will be a significant event in Bitcoin's history. It will mark the end of an era and the beginning of a new chapter for this groundbreaking cryptocurrency. While uncertainties remain about the specifics of how the network will adapt, the fundamental principles of Bitcoin, scarcity, decentralization, and security, will continue to guide its evolution. As we move closer to a world where digital currencies play an increasingly important role, Bitcoin stands as a testament to the power of innovation and the potential for decentralized systems to disrupt traditional financial structures. The journey of Bitcoin is far from over, and the next chapter promises to be just as exciting and transformative as the first.